What if I told you that some of the greatest fortunes in history were made during recessions? Let me start with a story. It's the 1930s, and the Great Depression has crushed the global economy. Businesses are failing, unemployment is skyrocketing, and people are in survival mode. But while most were running for cover, one man, John D. Rockefeller, was buying up stocks at rock bottom prices. His bold moves during the toughest times helped him amass a fortune that made him one of the richest people in history. The lesson: recessions create opportunities for those who are willing to take calculated risks. Let's explore how you can use the next downturn to build your own financial empire. Number 1. Look for undervalued assets. During a recession, fear causes many investors to sell off stocks and other assets at drastically reduced prices. This creates a unique opportunity for those who can keep a level head and look beyond the panic. Take Warren Buffett's actions during the 2008 financial crisis as an example. While the market was in chaos and major financial institutions were collapsing, Buffett saw an opportunity to buy. He famously invested $5 million into Goldman Sachs, a move that was considered highly risky at the time, but he knew that Goldman was fundamentally strong and had a future beyond the crisis. Today, that investment is worth billions more. The lesson here is simple. Recessions are prime time for spotting undervalued assets. Stocks, real estate, and even small businesses often get dragged down with the overall market, even though their underlying value remains intact. If you do your research, understand the fundamentals, and invest in quality assets that are temporarily depressed, you can set yourself up for massive gains once the economy recovers. In times of fear, those who can see through the storm often find the greatest treasures. The key is to act while others are hesitant, just like the world's best investors have done throughout history. If you are enjoying the video, hit the subscribe button and comment down your thoughts. If you want to explore money-making strategies, click the link in the description to start your financial journey. Number 2. Recessions are discount seasons for long-term investors. A recession is like Black Friday for investors. Imagine walking into a store and see everything at 50% off. You'd be crazy not to take advantage, right? Well, the stock market was in much the same way during a recession. Stocks that were once too expensive to touch can suddenly become affordable. But here's the trick. You need to focus on quality. Take the case of Starbucks during the 2008 recession. The company's stock plummeted as people cut back on non-essential spending. But those who understood Starbucks' business model, its brand loyalty, global expansion plans, and future growth potential, saw an opportunity. They invested when shares were low, and as the economy recovered, Starbucks soared to new heights, rewarding patient investors with massive gains. When you see high-quality businesses, those with strong fundamentals, proven track records, and growth potential being sold off, that's your signal to step in. Recessions may create fear, but for the informed investor, they are a time of tremendous opportunity. Number 3. Diversify to reduce risk. Diversifying your investments during a recession is one of the smartest ways to reduce risk and protect your wealth. Think of it like this. If you put all your eggs in one basket and that basket drops, you lose everything. But if your eggs are spread across many baskets, the odds of losing everything are much lower. Consider Ray Dalio, founder of Bridgewater Associates, one of the world's largest hedge funds. During the 2008 financial crisis, while many were panicking, Dalio's diversified portfolio held strong. He wasn't just invested in stocks but spread his investments across bonds, commodities, and other assets. As a result, he minimized losses and came out of the crisis in a better position than most. The key to diversification is investing in a range of assets that don't move in sync with each other. While one investment may take a hit, others may hold steady or even rise. In a recession, stocks might plummet, but real estate, gold, or certain commodities might surge. By spreading your risk across different sectors, industries, and asset types, you insulate yourself from the full brunt of the downturn. It's not about avoiding risk completely, but about managing it effectively to seize long-term opportunities. Number 4, build cash reserves for opportunities. During a recession, cash is king. It gives you the flexibility to act when opportunities arise. Warren Buffett is famous for always having a large cash reserve at Berkshire Hathaway. Why? Because when the market crashes, he can pounce on deals while others scramble to raise capital. A perfect example is his investment in Bank of America during the 2011 Eurozone crisis. Buffett stepped in with a $5 billion investment when the bank was under pressure. By having cash on hand, he was able to make a move when others couldn't, locking in favorable terms that have since turned into a multi-billion-dollar windfall. So how can you do this? Start by building an emergency fund that covers at least 6 months of living expenses. Then once that's secured, focus on growing a cash reserve for investments. This way, when the next recession hits, you'll be ready to jump on the opportunities that arise while others are stuck on the sidelines. Number 5, recessions are time to upgrade your skills. Recessions aren't just about surviving financially, they're the perfect time to invest in yourself by upgrading your skills. When times are tough, the job market tightens, and those with the most relevant skills thrive. Take the 2008 recession, for example. Amid layoffs and economic uncertainty, many people like Barbara Corcoran, founder of the Corcoran Group, saw an opportunity. She spent that period learning more about digital marketing, real estate data trends, and leadership. Those skills helped her rebound when the market recovers and further propels her real estate business. Recessions force industries to adapt and evolve. Technology becomes more critical. Certain industries shrink while others grow. This creates a demand for new skill sets. Whether it's mastering digital tools, improving financial literacy, or learning something as specific as coding or project management, enhancing your skill sets positions you for better opportunities when the economy picks up. Think of it like building your personal moat, protecting yourself from the volatility of recessions. People who focus on self-improvement during downturns often find themselves ahead of the curve, ready to capitalize on opportunities that others. While the world pulls back, upgrading your skills is the ultimate form of investment that pays dividends in the long run. Number 6, take advantage of government programs and incentives. Recessions often lead to government intervention, with programs designed to stimulate the economy. During the COVID-19 pandemic, for instance, many governments around the world launched stimulus packages offering grants, loans, and tax incentives for businesses and individuals. If you are savvy, these programs can provide a financial boost when you need it most. Consider small business owners who were able to secure no-interest loans during the 2008 financial crisis. Many of these entrepreneurs used the funds to expand their businesses at a time when competitors were shrinking. When the economy recovered, their businesses were positioned to thrive, allowing them to outpace the competition. Make sure to stay informed about any government programs that can help you during a recession, whether it's more business support, grants, or tax breaks. These incentives can give you the breathing room you need to invest in your future and come out stronger on the other side. Number 7, invest with a long-term mindset. One of the most important things you can do during recession is to maintain a long-term perspective. It's easy to get caught up in the panic of short-term losses, but remember that recessions are temporary. The stock market, real estate, and businesses have always recovered from downturns in the past, and they will again. Take the story of Amazon. During the dot-com bubble burst in the early 2000s, Amazon's stock plummeted by over 90%. Many investors bailed, convinced that the company was doomed, but those who held on who believed in Amazon's long-term potential were rewarded beyond their wildest dreams. Today, Amazon is one of the most valuable companies in the world. The takeaway? Don't let short-term fear dictate your long-term strategy. If you invest in strong businesses, build diversified portfolios, and maintain your focus on the future, you'll be in a prime position to grow your wealth as the economy recovers. So there you have it, 7 powerful strategies to use a recession to your advantage and build wealth while others are struggling to survive. Remember, recessions are temporary, but the wealth you build during them can last a lifetime. If you found this video helpful, don't forget to like, subscribe, and share with others who want to turn a downturn into a financial opportunity. Thanks for watching, and we will see you in the next one.